it is a tradition at the Milken Institute to save the very best session of the conference for Thursday morning. And so we have done that again this year with credit trend. And I am very happy to have three titans of the credit markets in this room with me today. There's so much talk about the difference between Wall Street and Main Street, and credit markets, I think, are really where Wall Street does meet Main Street. So this could not be a more topical conversation to have. And so I am joined, and you know, I was noticing everybody's titles, and in this era of kind of strife, I also think it's good that we've got three people that know how to share power and make decisions with somebody else in this room. So we've got Rishi Kapoor, who is the co-CEO of Investcorp. Not to be outdone, George Hicks, who is the co-founder and co-CEO of Värde Partners. And not to be outdone, Josh Friedman, who is the co-founder, co-chairman, and co-CEO of Canyon Partners. So he wins the Sharing Power Award for this room. So what I want to do in kind of a broad narrative arc for the discussion is talk about kind of, you know, what has happened to companies and to the underlying assets with the pandemic, and then sort of how does that affect credit markets? What has been the Fed's response? How do we feel about that response? And then kind of looking forward, you know, what do we think is going to happen? What does the Fed and fiscal policy have left in terms of its toolkit? And then are there any opportunities? So that's kind of broadly how we're going to run this thing. So Josh, let me start with you. Can you kind of paint the scene for us pre-pandemic? How would you have characterized the credit markets there, and how were they positioned as we kind of went into this?
Thank you very much, Staci. It's a pleasure to be on the panel, and I apologize if we don't have perfect sound here, but I'll do my best. I think we were really stretched, and we were in a frothy state and very, very precarious. And I think there were really three parts of that. One is in the decade prior to COVID, there was an explosion of mismatched capital structures on the buy side. And what I mean by that is mutual funds, ETFs, and others owning high yield, owning bank debt, et cetera, but with daily liquidity that they were offering to their investors, yet securities that can't be sold on a day. And that mismatch was even exaggerated by the fact that many of these structures were even leveraged, maybe not as severely as, you know, subprime loans, but there were people leveraging ABS securities and other things. And in this desperate hunt for yield that was taking place in a world of declining yields, people went to excess. So that the first thing is that sort of explosion of mismatched structures that was starting to dominate the terrain. And people were being rewarded for investing in them, because when rates went down, money would go into a high yield fund, they'd buy, the prices would go up, they'd say, that worked well, and they'd do it again.
So
the second thing, so that was sort of the first part. The second part went with the first part, was a significant deterioration in the quality of those credits, both from the underlying credits themselves and the credit protections that were offered to creditors. And some of those things would be, for example, record high level of debt to GDP, poor covenants with all sorts of holes in them, and more aggressive sponsors taking advantage of those things. Debt to EBITDA that was not only at record levels, but the EBITDA was adjusted EBITDA. It wasn't real EBITDA. And for the first time in the history of high yield, over half the bonds that were issued in the private markets as opposed to the public markets, which is a way of avoiding the kind of controls that the public markets provide. So you saw a lot of these excesses taking place, 85% or so of bank debt being covenant light, which really meant covenant free. So in the competition for yield, in an expanding environment, right, expanding economic environment, very few defaults, so you could get away with this, but it was setting up for a problem, especially in combination with those mismatched structures. And the third and last thing I would add to that is that because of the global financial crisis, there was such focus on the financial institutions and the intermediaries who usually provide liquidity, act as principals, make markets, that the bank balance sheets, while they were deleveraged massively and were made quite safe by all of the regulatory frameworks that were created post GFC, whether that was Basel, whether that was Dodd-Frank, Volcker Rule, et cetera, it really meant that the market makers had left the scene. So when something happens, whether it's a recession or anything that causes a problem to those very leveraged structures, there was a risk that the floor would be quite a bit lower than the current levels.
You know, Mike Milken has joked that he was going to start a Pix Anonymous support group for, for folks that couldn't get away. But when you say, you know, if a problem happens, you're sort of at risk, but how would you have characterized what was going on in, quote, Main Street? How are companies looking? How are you thinking about, how would you have characterized kind of profitability, et cetera?
Well, it was good. And I would add one other factor I didn't mention that I should have mentioned was that in that decade between preceding the COVID crisis, private equity exploded. So leverage was applied to so many companies in so many industries. And Main Street was looking pretty good. Unemployment was low, GDP was growing. So there weren't a lot of signs of distress, except in companies that had been rapidly disintermediated by technology and by digital media. And so you saw retailing, which was already on the edge, which of course was the first to go over the cliff when things happened. You saw problems in energy that were created. But generally speaking, Main Street was doing pretty well. Businesses were thriving. People were going out, and from small businesses to large businesses. And everything was getting financed and money was pretty easily accessible. People in related industries to the industries that George and I are in, for example, and I'm sure Rishi saw plenty of this because they come looking for capital everywhere, were exploring far reaches of the credit world to lend money to Main Street. BDCs, leveraged BDCs, NPL funds, people were exploring every little niche they possibly could find to look for yield. So businesses were benefiting from low rates, from a good economic background with low unemployment, and I think they were doing pretty well. But it was so stretched from a credit point of view that you had to believe that a little bit of jostling that could even just alter confidence could cause a quick unwind. And that could include just rates going up.
Right. Do you think it's fair to consider the global coronavirus a little bit of jostling, perhaps, to these companies in these markets? Why don't you know, Josh just talked about kind of moving towards a cliff, and I think, you know, it's safe to say we've gone over that cliff in certain important ways. What does it look like now in the valley there when you're kind of looking at the landscape, and also kind of give us a sense of kind of maybe sector by sector what you're seeing with the companies themselves?
Yeah, well, let me first of all start off, Staci, by thanking you and everyone at the Milken Institute. I join you today from sunny Bahrain, adorned with my latest tracking fashion accessory. You know, but Josh, you know, phrased it well. You know, the market was fueled by, you know, a 10-year plus bull run, if you will, certainly in the US, but pretty much globally. And in particular, you know, private equity, private credit, and real estate, the three generally deemed to be liquid asset classes, had gained significant prominence during that 12-year period. Now, as you said earlier, when you're down in the valley, having fallen over the cliff edge, and you look around you, it's pretty clear that there's a big difference in terms of outcomes across company types, company sizes, and sectors and geographies, right? Okay. Now at Investcorp, as you know, we cover a lot of ground. You know, we are active in private equity, we are active in private credit, we are active in real estate, and we are active in US, Europe, and Asia. So, you know, in terms of geographic footprint as well as asset classes, we have a pretty unique lens, and we can see, you know, we can see how the financial sponsors are behaving as owners of companies, how the creditors are behaving like us that have lent to the very same companies, and how landlords are behaving again like us, you know, that have tenants, which are typically corporates, you know, that are suddenly having to deal with a zero revenue situation. Let me start off with real estate first. It's pretty clear in real estate, there's a striking difference between retail hospitality on one extreme, industrial, particularly fueled by e-commerce on the other extreme. Multifamily has held up well, mainly because of the PPP, you know, the government programs that has sent, you know, $600 per week into people's hands. And office, I think, is somewhere in the middle, mainly because people are still trying to figure out what it means in the long run, this social distancing and so on. But if you use delinquencies as a measure to track health of real estate, I would say industrial and multifamily have held up pretty well with 2 to 3% delinquency rate. If you pivot from real estate to the corporate sector, the large companies, whether they are private equity backed or not, or listed or not, clearly have a significant advantage, a head start relative to the mid-market and the smaller end of the corporate sector. And being a mid-market specialist ourselves, we can see that whilst for the big corporates, the government fuel programs have created a tsunami of access to liquidity, some real liquidity injections, some just through pounding the bully pulpit, if you will. The mid-market, there is no funding available. It's down to the financial sponsor to be able to triage and figure out which 10% of their portfolio is not going to be able to make it because they are in a business sector that is going to be impaired, and there is a liquidity situation that you cannot overcome, right? And you focus therefore on the other 80-90% where you can provide some additional capital from your own resources, particularly in sectors where there's a secular tailwind and there's a reason to exist, if you will, right? So I think that's the way we see it. Geographically, again, we tend to follow the US the most, but outside the US, and I'll just leave you with one stat here, Staci. The high yield funds, retail fund flows into high yield, were negative for 3 weeks in the US, and every week since then they have been positive. Same with investment grade. Retail flows into EM credit funds have been negative every single week since mid-March. That should tell you what the credit story looks like outside the US and developed markets.
And what about the underlying story in developing markets in EM?
I mean, the underlying story, we are active within the EM space. We are active in India. So I'll talk about that. We are, to some extent active in China, but in China, we do it with partners. In India, we have our own office. In India, it's a tough situation underlying, right? Because, on the stringency index, the Indian government probably, got 100 out of 100 in terms of the severity of the lockdown. And because of that severe lockdown, they have, put their economic engine back by a factor, multiple higher than most of the developed world. And there is going to be an issue. And the big difference, of course, as all of us know, is unlike the developed markets in the US and in Europe, emerging markets, the central banks do not have a printing press. They cannot go and just keep printing money to finance their own fiscal stimulus.
George Hicks, can I kind of ask you to expand on that and also to focus a little bit on just kind of how has everything that Rishi's talked about reverberated back into credit markets themselves?
Great. Well, thank you, and delighted to be here and delighted to be on a panel with my friends Josh and Rishi. Värde, just briefly, we're a global credit shop, run a global credit book, so we have some interesting lenses on what's going on. And so as I think about how this translates back and the comments that's gone in front of me, I do have to make a comment about the Fed's response. I know we're going to spend a lot of time on that, but you really can't understand the credit markets without thinking about what the Fed did.
Yeah, that's fair.
And so point one, which I know we're going to dive into, has been I'm going to try to not use words like extraordinary, unprecedented, so I'm trying to think of a different adjective, but the major responses that we've had by the Fed, the fiscal stimulus and the like. And so lots of parts of the credit markets are in great shape. At least in the new issuance side, and so if you look at investment grade credit in the U.S., new issue of $1 trillion. A couple weeks ago, I know was the biggest week ever for new high yield issuance, and certainly we've seen a bit of not total round trip, but the very tight spreads and conditions that Josh was talking about. Those spreads blew out, and now they've come back in quite a bit, not all the way in both the high yield and the investment grade markets. And so at least in the larger markets, there are parts of the credit markets that are pretty robust. But the main point that I hearken back to is that we're also in a recession. And I think that's pretty undeniable, and we'll probably talk later about how deep it is, but it is a recession, probably measured since February. It's deep. We've got in the US, 20 million people unemployed, unemployment rate at 13.5%. IMF numbers just came out, and it's not a pretty picture globally. And the fact of the matter is, you can't talk about the credit markets without recognizing that recessions have consequences for credit markets. And parts of that are being masked by the Fed. And the thing I like to think about, and I know my panelists have seen this often as well, whenever you have a recession, ultimately you're going to see defaults go up above 10%, however you want to measure it. And I use that as a shorthand way to talk about there are going to be some challenges ahead for us. And there's often a delay between the time when you have the economic downturn and when the stuff hits the fan down the road. And we can look at past examples of what's happened. But typically, if you look at the global financial crisis, troubles hit. A lot of the opportunity set is in the more liquid public markets, which is where a lot of us have played, and now it's starting to move into a different set of opportunities. We're not to the point of restructurings or NPL trades, but they're down the road. And so there's going to be that implication for the credit markets as well. And so there are those troubles. And I don't know that I'd say they are or aren't priced in yet, but that's ahead, and there's a bit of a reckoning there.
Rishi talked about sort of 10%, abandoning kind of roughly 10% of portfolio, and you're talking about 10% default rates. I'm wondering, are those the same companies that are, defaulting because they're not getting the support from private equity and losing access to the market? Or do you think there's something more structurally underlying going on?
I think it's there's probably some similarities, but there's differences. What I'm talking about is just more the basic economic impact of the deteriorating economy. And the fact of the matter is, we haven't really fully seen that yet. We're just, particularly in the middle market, a lot of those numbers are just starting to come in. What are the real rent rolls? What are the impacts of the shutdown? What are the impact of the pandemic and coming back to work? And so we're just seeing that as we go. And even though the Fed and the government averted Armageddon, massive bankruptcies, and unemployment, which is great. I mean, I think there's kudos there. You still can't fix all the problems, and those will be playing out in time ahead.
Okay, I want to kind of open this up as a roundtable going forward. But Josh, let me start with you. Did the Fed, I get it that they have lessened some of the, deleterious consequences of what was happening in markets, but have they set up a Potemkin village now? I mean, is this all fake, or is it, anyway, what do you think about what the Fed's done, and what do you think it means?
I know you asked us to try to disagree with each other to make this a little more interesting, but I'm gonna vociferously agree with Rishi and George here. I apologize in advance, but I want to draw a distinction. There are things the Fed can do and things they can't do. They can absolutely restore liquidity to credit markets, but liquidity is not solvency. And if you have a balance sheet that is not built to last, and you give a big jolt to the economy and you're in a recession, it's just a matter of time before that balance sheet has to be restructured somehow or other. And I think that what the Fed did was, the good news about it, it took big employers who were cuspy investment grade people or maybe high yield people, and gave the market the confidence to come in and front run the Fed, which became the first trading opportunity, of course, because you knew the Fed was coming. And by the way, they're going to do it in municipal bonds. They're doing it with the primary facilities, but nobody likes their terms. But they came into the money market accounts. The Fed is great, and I think what they did was wise, which was basically give people confidence in the capital markets, especially since the central banks and the central governing bodies went to such great lengths to make sure that the commercial banks and investment banks couldn't provide that liquidity because of all those regulations. So by giving that confidence, it was great for a certain class of companies. And with low interest rates, it does have a real effect on others, and it does produce some drafting effect that eventually has an effect on the lower grade parts of the market, all the way down to triple C. But at the end of the day, private equity was on a huge run. I guarantee you that the partners at the private equity firms, when they were looking at a lot of these detailed deals that they were done in the last 5 years, did not say to the vice presidents and the analysts, please do a pro forma spreadsheet that includes 0 revenue for this company for the next 3 months, followed by quite a hell of a recession after that. And so getting from here to the end of the summer is one thing, but just talking to these private equity firms, there's a lot of triage being done. There are already, I think the one thing I would say in response to George, and we're in some of these deals together, of course, in the distress side, there are some very good companies that had balance sheets that immediately went into distress. You know, Travelport would be an example of an oligopoly business that had its revenue basically shut off with a very leveraged balance sheet. But there will be others, and I think patience is going to be required there. But the Fed, again, liquidity that they can provide, that's great. And to restore confidence that the capital markets can function when they literally are frozen and not functioning, that's great. But they can't fix over-leveraged balance sheets. That's a whole other discipline that's not in their mandate.
Yeah, and the other thing that the Fed is going to struggle to fix is, you know, the first leg of this recession, I think we all appreciate, is driven by the supply shock, right? You enter a lockdown, you shut down the economy. Well, you're going to have a recession. Fine, we all get it. So you have a fiscal stimulus, you send checks to every household, and you print money, tons of it, and you use the threat of printing even more money to get people in line in the capital markets. But the second leg, and that's what frankly worries me the most, or us the most at Investcorp. But the second leg is really driven by the fact or recognition that the CARES Act, has a sunset to it at the end of July. And if you look at the stats, 95% of the base of the pyramid in the US has either lost a job or has had their pay cut, right? And when those checks stop flowing, these people who have actually spent 96%, there are two 96s over here. I apologize for the confusion, but 96% of the paychecks that they received, they have spent, right? It's, kept a floor on the fall in consumption, over the course of April, May, June, and through till July. But when that floor goes away and the consumer is not quite as buoyant anymore at the base of the pyramid, that effect is going to keep, start trickling up, right? I know it's oxymoronic, right? You trickle down, not trickle up, but you get my drift. That trickle up is going to, and we are seeing this already. The first round of unemployment claims were all in the front, the leisure, retail, entertainment, those kind of industries. The second round of unemployment claims that is beginning to surface now is real estate, financial services, white collar services. When that starts happening, then you see the second leg of the recession. And that second leg is a demand drop, right? Because you are now migrating from a supply shock to a demand destruction caused by people's paychecks being smaller, the size of their wallet being smaller, the size of disposable income being smaller. That's a lot more concerning, frankly, right? Because the Fed, with zero interest rates already, is going to start feeling the pinch in terms of running out of tools. You can make the capital markets behave through quantitative easing, but how do you create employment when you're already at zero interest rates and business models are facing a solvency threat?
To add a couple points to that, as we think about these factors and its impact on the credit markets going forward, and just focusing in a little bit more in the U.S. now, and hopefully it'll shift internationally in a little bit. Certainly there are more things to come, I think. I would expect there to be another fiscal response in the U.S. needed. I think in an election year, it's hard to imagine we won't. There'll be a little debate as to its size, but that's going to happen. But then the other big one is, we're in a recession. What is the shape and how does that unfold? And of course, we all get to pick out our letters and V's and swooshes and stuff. And I think recent events don't point out that it's a V. But I think it's what we're going to find is it's probably easier to shut down an economy than it is to reopen it. And I read a good analogy, a fun analogy. I think it was Peter Orzag talked about the economy and likened it to a beach in Cape Cod. And so in the summer, everybody's at the beach. They have a great time. The winter comes, you close the beach down, and then the summer comes around, and everybody's back out, and it's full. Then when you close the beach down because of a shark attack, okay, and everybody clears out, it takes a long time to get people to go back, particularly if there's a second shark sighting, and that might go a couple of years. And I think that's a big thing that we're seeing. We're going around a bit, but it is pandemic related. The fundamentals are going to tie to that. It's going to take time for all of us. We can just see it in our lives and our employees' lives. I mean, people aren't running to get back to work. We're not going to open Disney World, things like that. And then, the backdrop, of course, is what happens medically. And I think, someday, and the markets will love it, we'll have some positive news, say, on a vaccine. But I think it's a ways off, and it's going to take a while to actually roll it out. And so, I'm an optimist, but this thing's going to go on for a little bit a while, and that's obviously what's going to underline the credit markets, and gets a little bit to the disconnect between the powerful impact of the Fed stimulus and the reality that's bubbling along below.
Worse than the beach house. I mean, you can see those damn sharks, the fins in the water and the music plays. I mean, nobody knows where this virus is. That's so much of it. Right?
Yeah, true.
Yeah. I was going to add that to the points of Rishi and George, that the other thing that happens is you're in kind of an unusual time politically in the U.S. because it's an election year, and you have issues with respect to international trade that are really quite profound for the economy. And both parties piling on in that area with respect to China. You could have sharp political movements in terms of policy that could happen in September that could be either good or very bad for the capital markets. So
what would those be? What would you consider a stark policy move?
Well, if you had a triple header Democratic sweep, I think that would be regarded by the markets as being at least presenting the possibility. But that depends a little bit on what the presidential candidate says about his policy directions along the way. Will he move to the center? Will he not move to the center? So I think that you have two different kinds of outcomes there. What's interesting is that the first steps, the Fed, as everyone's discussed, yeah, they can definitely put out the initial fire, but this is going to smolder for a long time. And you see it in the types of trades in the market, right? The first trades were front run the Fed. They didn't even have to go in and buy anything under the secondary market corporate credit facility because everyone came in ahead of them and did it for them. But that was the first thing: buy the high yield index, buy the IG index, kind of trading things. The second thing was, okay, businesses that were already on the brink definitely fell into the ditch immediately. Immediately, do not pass go, Neiman Marcus, J. Crew, J.C. Penney, etc. So then you saw people doing dip loans to those companies, mostly existing creditors trying to elbow out their colleagues who weren't allowed to participate in the dip loans to get a little bit of an edge in the declining pile of assets that were remaining. I mean, that's the reality of those. And then the next thing you saw was a bunch of really interesting stuff in ABS land, because people had leveraged things with repo debt to buy somewhat somewhat illiquid assets. So those kind of those moved pretty quickly before they shrunk their balance sheets and stabilized them. But now comes the interesting part where, as George says, pick your letter. And I don't think I don't consider us to be particularly great at prognosticating exactly how long the U is, except to say that it is a real recession and there will be real companies that have to restructure. I think the strategies for taking advantage of them will be different because the PE firms have so much capital. So I think some of these will be conventional face off and fight the sponsor bankruptcies, but others will be more, okay, let me figure out how to help the partner, the PE firm get from here to here and deleverage the balance sheet where they can be part of the solution, not just be adversarial with the creditors. And that requires third-party participation. And I think that's an area that we're going to see a lot of. But those opportunities will require patience, I think, and a little more visibility before we know what's the right. You don't know what the right balance sheet is unless you have at least a little better visibility on what the outcome's going to be.
Yeah, but patience on your part is hard on the company's part, right? I mean, it can.
Yeah,
Always.
And I think that's where the triaging is happening right now. Many companies actually, and I think it was discussed in one of the earlier panels at the conference as well. Right in the early days, most private equity-backed companies, the first thing they did was they drew down on their revolving facilities, right? Everything that was available to them, and created a liquidity buffer to that. Pick your number, somewhere between 6 to 9 months of liquidity, and then that gives you the room for maneuver that you need to figure out: A, is your business model still intact, or do you need to make changes to it? But B, more importantly. And this is where we kind of pivot from looking at everything with the glass half empty lens to the half full lens, right? More importantly, you do have some offensive firepower available to you to go out and gain share, right? Gain share not just in terms of acquiring businesses that may be weaker or weakened as a result of the pandemic, but acquiring talent as well. We are in our private equity business, but also in our credit business in the developed markets. We are very focused on services businesses, right? Blue collar, white collar, tech enabled services, generally speaking. And we are seeing it in our own portfolio. They've generally held up well so far. And they are well positioned to, having sorted out what their defensive moves were going to be. They're well positioned to look out and create something that could, in the long run, actually turn out to have more value than you could have extrapolated pre-COVID, right? So there is certainly that opportunity that we see on the horizon.
Those of you in the audience feeling a little precarious, Rishi will be accepting CVs at the end of this session.
I'd like to maybe just pivot a little bit to the credit markets outside the U.S. I know all three of us have that lens, and maybe a couple comments. I think we all have some views on it. But one of the first things that we saw in the credit markets is they often will follow the U.S. And so obviously when the troubles hit in March, April, we saw the spreads blow out. A lot of the same factors. And then interestingly, maybe both in Europe, but also in Asia, once the stimulus started to come into play, it sloshed around and impact those other markets. And it was both liquidity, but it was a lot of the search for yield. We talked earlier about how we were all playing the investment grade play. I felt a little bit like visitors to a foreign land when we had all those investment grade opportunities, but we're probably moving from there. But we saw the U.S. stimulus, the folks moved out, and so we saw the recoveries in probably those credit markets as well. But there are two things that I think about as I think about the international markets. And one is just, each market, and it's hard, there's so many markets, reality, have different capabilities to bring fiscal and monetary stimulus to bear. So Europe's an interesting one. The big story there is I think Germany has finally thrown in the towel on not doing any stimulus. And the backing, the big thing that we're all watching, of course, is whether that $750 billion stimulus package gets passed. And as you think about the credit markets, that's big. If it doesn't, I think that'll be a big setback for the markets. And then as you look around the rest of the world, China is a lot different story than India. I know, Rishi, you know that market well. And those different pieces to play. But I just think about a lot of the emerging market countries don't have the capacity to bring the monetary or fiscal stimulus that we've had in the U.S. and a lot of the developed countries. That's going to have a big play, and we know how much corporate debt's grown in the emerging markets. And I think in a lot of ways, just like I talked about the reckoning ahead, that's going to be true outside the U.S. in different ways, because they've got a recession as well. And that reckoning is going to play out in the credit markets in the months and few years ahead.
China does surely
Yeah.
have sort of dry powder and ability to have a fiscal
Yeah,
stimulus.
China is a whole, they're kind of a whole different case. You got China, they're more like the US. Mexico, for example, which has troubles. I mean, they're only able to pull up fiscal stimulus equal to, 2% of their GDP versus the US is 10%. I mean, look what we've done with our balance sheet and having the reserve currency. So yeah, there are plenty of countries that can bring firepower. Australia's done a lot, but there are a lot of countries that don't have that same capacity to have it spill into and help out the credit markets.
The thing that I'm trying to understand, and I don't pretend to understand right now, is what the long-term effects will be in the US given the magnitude of the stimulus, and not just the magnitude so far, which is already enormous, but the likely magnitude by the time we're done, because I do think there will be more down the road, particularly since we're in an election year. So, George talked about 10% of GDP. By the time we're done, I'm sure it'll be quite a bit larger. And I'm not sure that I understand the limits of both fiscal and monetary policy, and what that does. In the short run, you might say it's relatively unconstrained, but in the long run, what does that mean for the U.S.? And I don't know the answer to that, but I think that's going to be an important thing that we have to reckon with.
Yeah, let me expand on that a little bit, because my story for thinking about this is kind of like Hong Kong versus Godzilla. You've got the King Kong. I mean, you've got the sort of King Kong of policy versus the Godzilla of this virus, and who's going to win. But then, what's the landscape going to look like when the battle is over? And even if we do find ourselves in a recovery, whenever that is, what will the overhang of this kind of policy look like in the economy? What kind of structurally, how will the economy have changed, and how will financial markets potentially have changed in the wake of all of this kind of a policy response? I mean, anybody got a crystal ball on that at all?
Well, I'll hazard two observations. One is I actually think that in terms of the basic economy, when we get out a few years and past the pandemic, I think in certain ways it'll look more familiar than different. Okay, because I do think we will get past the pandemic. We'll get back. Hopefully, maybe we'll have learned some better ways to operate and some things like this. Maybe have set up some precautions for the next pandemic instead of being caught so unawares. But I wonder if the economy in a few years won't return kind of to normal. And I think the bigger impact was something that Josh was starting to touch on. And that'll be the long-term impacts of some of the steps we've taken to deal with it. And, we're going to have built up the Fed's balance sheets. We're going to have to pay for that somehow. Will we have financial repression? Will we have to have increased taxes, which is going to have a loop back that hits the economy as you go forward? I think that's a big thing. And then there's just thinking through, how do the markets react? Will they always think there's a Fed put? I actually don't think they will, because we're not always going to be in a pandemic. But I think there's going to be a lot of impact more on how the financial markets operate. But, might not agree with that, but that would be a
What would that financial markets impact look like?
Well, I think that there are two things, but one logically will be increased regulation, whether there should be or not. I question whether that'll add stuff, but I think we will see increased regulation because of the pandemic. I think there's going to be a continuation of opposition to globalization around the world. I think it's going to be more difficult for the free movement of capital and so forth. It's going to continue, but I think that will be a big piece of it. And then the other part is just to think about it as a participant, call it the moral hazard. Will people count on a Fed put? I mean, is that going to keep market levels elevated? And again, I'm going to offer the thought that no, at least for the credit markets, because I think the Fed stepped in to help out the credit markets, because a lot of the problems we had were government, and it was the government's response, and it was part and parcel of that effort. And maybe I'll finish with this, is now and then I hear folks say that the Fed bailed out the high yield market. And as Josh was saying, well, they really didn't do too much. I mean, ETFs are 5% of the high yield market. Fallen angels, I think they've spent $220 million. So the possibilities has certainly been big for the functioning of the markets. But the next time down the road, if we have a garden variety recession, I don't think the Fed's going to come in to bail out or to help out the credit markets, maybe the functioning, but not the credit markets themselves, particularly the lower ends of it.
If I may add to that, actually, just picking up from what George just said,
Feel free to disagree, anybody as well. Just once or twice would be great.
No, I'm going to not vehemently disagree, but just going to kind of go in a slightly different direction. But picking up from that, though, there is continuity here to some extent. The last 5 years, if you look at maybe even longer, at the credit markets in the developed world, they'd basically become beta driven, right? Pretty much everyone was, on that same rising tide, and they were kind of delivering the same returns, whether it was in structured credit. I'm talking about the performing credit market, right? So whether it was in structured credit, direct lending, everyone was in that 5, 6, 7% mid-single digits in direct lending. Everyone was, kind of low double digits on CLOs and other structured credit on the equity and so on. I would wager that coming out of this in the new world, there is a lot more room for alpha, true alpha, in the performing credit space, because credit managers can, in fact, if they do their research and analysis right, they should be able to figure out, which businesses, which investments are going to perform, and which ones are going to have to, redefine their business model in the new world, right? So there is an opportunity to create some separation between the top quartile and the rest of the pack. Otherwise, within credit, you always had, the median, and everyone else was clustered within, 50 basis points of the median. And I think that separation around the median into top quartile, and unfortunately, as a consequence, also bottom quartile, is much more likely to manifest itself over the coming 18 months, mainly because all credit managers with portfolios today do not have the same portfolio, right? So they're going to have to deal with the consequences of that. I'm actually pretty cautiously but optimistic about it.
Josh, you've talked in the past about sort of the structural infirmities of credit markets. Do you think any of these will be improved, resolved? Will people learn a lesson from this? Do you think we'll see structural improvements in the quality of markets when we get out of this?
I don't know. Rates seem like they're anchored permanently at very, very low levels. There's pressure to have negative rates. I think politics interferes with free markets in a lot of interesting ways in these types of markets. So I don't know the answer to that. And when there's a global, desperate search for yield because there are pension funds that need to pay off obligations, or there are endowments that need to pay pay the operating costs of the universities, or there are just, anyone who seeks yield. It seems like there's been such a rush of capital that discipline's broken down. But I think the sudden loss of money on things has a way of disciplining markets. So I'm optimistic in the long run. Balance sheets, capital markets can be supported. They can be, you can cause a lot of activity to make them look like they're functioning well. But at the end of the day, the nice thing with credit analysis and competitive analysis of companies' positioning in an industry is either the debt can be paid off or it can't be paid off. Either the spread was big enough so that you own a basket of them and it worked, or it didn't work. And I sure hope that Rishi's correct, because it makes our job of trying to sort out the ones where you can make money versus the ones where you can't a very gratifying and productive use of time. But I also think there are things that are becoming more permanent parts of the landscape that we're not accustomed to. You know, Margaret Thatcher used to say how there are only a couple of sources for solving this problem. We can tax people or we can use our savings. That doesn't appear to be the case any longer. And I think different versions of modern monetary theory are creating relatively permanent departures from that, or at least long-term departures from that. And I think that does kind of warp the traditional approaches toward capital markets. So I do think that a few good defaults and some capital loss, you know, get the euphoria out of the room. That's not a bad thing at all. But it sure came back awfully quickly with the Fed, you know, keeping rates low and providing some stimulus at the high end of the markets. Sorry, Rishi, I interrupted you.
No. So yeah, I was just going to add, you know, make Staci happy, disagree a little bit. I think the one good thing coming out of this, Josh, relative to, you know, your somewhat more pessimistic outlook, I think documentation gets tighter on the loans, right? Just the direction of travel over the course of the last 10 years on the loan documentation, you know, not just the fact that there were no covenants and so on and so forth, but generally sloppy documentation, allowing baskets and God knows what, add backs, etc. I think people have learned their lesson.
I think they also have the behavior of the PE firms, you know, whatever tricks the more aggressive ones were using have now been, you know, transmitted to all the other PE firms. So you have a lot of aggressive players out there. So I hope that's correct too. I really hope that's correct.
Okay, how about a little bit of a pushback in the form of a question from the audience? And George, maybe I'll start with you on that. And this is, look, you know, there's been a lot of opportunistic and special situations capital that was raised in April-May timeframe, right? Markets have now rebounded. There's a lot of dry powder in the system. Where is that discipline going to come from?
Well, we discussed that a lot, amount of money available. I mean, there's a couple of comments that I'd make. Number one is you just have to look at the gross size of the credit markets, okay? And the credit markets have doubled since the time of the GFC. So just as a numerator, you know, there's a vast amount of debt out there that comes into play. You know, the second piece is that as this opportunity unfolds, it unfolds over time, and there's a lot of ways that people can play it and look at it. And the public markets are and still are an important piece of where you can play it, but that's going to quickly shift into the more private opportunities and the more workout and value-added and complicated opportunity sets. And so, you know, we always are asked that question, players like us, isn't there too much capital? It was asked in 2008 and 01, et cetera. And that's always an issue. I'll just put off to the side the fact that our biggest competitor in 2008 was the street, and they don't carry anywhere near the same balance sheets as we're aware. But the other thing I just want to bring up, and it's been touched on, is how playing this opportunity has changed so much over the last 30, 35 years. And it isn't really going to be there'll be some traditional bankruptcies, restructuring, some NPL plays, but it really is going to increasingly be a story, not just globally, where it's been true for a while, but in the US, where there's going to be more of, call it structured capital solutions, providing rescue capital for extensions, and the like. So there's going to be an interesting change in how we all play it, and I know both Josh and Rishi touched on it, but that's going to be a piece of what unfolds over the next year.
One of the things I've seen, at least that George and I have focused on in different areas, and there's a relatively small universe of people like this who have the size to be able to deal with solving a large problem, but are not private equity firm branches, is that the PE firms don't necessarily want to approach their competitor, even if he has a capital market solutions fund, to solve a problem that PE firm has. They'd like somebody who's sort of not a competitor of theirs per se, but who can have that sophistication. And that's the shape of actually restructurings that are already taken place since COVID. And I think we'll see much more of that. I agree with George completely on that point. Again, I apologize for not fighting back. But I think the old game of loan to own and the price goes on and you down and you buy more and you buy more and you buy more and you fight with the sponsor. Yeah, there will be a few of those, but I think that's the exception. I don't think that's going to be the rule.
Yeah, buy you guys some cakes.
And just to underscore that point, I mean, in India specifically, because of the challenges in that market that George, I'm sure, is well aware of, you know, the opportunity for a greenfield newco with no legacy overhang, looking to provide capital solutions as opposed to being a lender or whatever, is something we are actively exploring.
Yeah. Let me shift a little bit to a kind of a policy question. And this comes from our own head of Center for Financial Markets, Mike Pivovar, who, as you know, used to be a commissioner at the SEC. And he's asking the question that, on the one hand, you've got much stronger bank balance sheets. But on the other hand, you've had a lot more restrictions on their dealer and trading businesses because of regulatory effects of Dodd-Frank, et cetera. And so, the Fed has stepped in and again to kind of provide the well-functioning of these markets. So if you could, wave your magic wand, what kind of regulatory changes would you like to see that would improve, not necessarily your business, but just the well-functioning, the underlying kind of financial plumbing of markets? Anything that you see would, make markets more resilient, make them more well-functioning that you'd like to see changed?
I'll start off with just one suggestion. The whole, I think Josh opened with this. What triggered that flash crash in the second week of March to a large extent was actually retail withdrawals from funds that were invested in illiquid loans and other securities. So that mismatch clearly is there. I would hope that that's an area of regulation that gets some scrutiny.
Retail withdrawals or what? No.
No. I just don't want that extreme duration mismatch.
So what I might throw in would be increased Fed transparency. I know that isn't purely regulatory, but a little bit where we're at now is with what the Fed's done. The notion of the Fed put is out there, and extraordinary circumstances under, but I think it's preventing some true price discovery. And I think going forward, if the market could have a better understanding when and where the Fed will step in, I mean, it can have positive impacts, but it also would let the market operate and have better price discovery going forward. And so I think that would be, I know it's hard to do, but I think that would help in the market. And, in some ways it's negative, but if the market thinks it's always going to get bailed out, I think some negative consequences develop over time.
Yeah, I don't have a lot to add to what Rishi and George has talked about, except to say that, in the old days, pre-GFC, every time you'd try to buy bonds, the street would essentially front run you. Now, you can't say that to the street. They get really offended. It's, a highly charged word. But if you did it in equities, God forbid, you'd be in huge trouble. But somehow every deal was a principal trade. They ran a position on the street that was, George mentioned earlier, they were the largest buyer in the high yield market. They owned 15% of the market or whatever it was. So, and now the good news is they're acting as agents. So they actually are acting as agents for us as opposed to acting as principals in quite the same way. Yeah. On the other hand, the market does lose something for that because there's a liquidity that's now been dispersed amongst people like all of us on this call and others who are sort of providing some of that market making function, not as market makers, but we'll throw out low bids and the street isn't there to cushion it. And I think the markets could function better maybe with some type of better intermediating role by the banking community that still isn't necessarily subject to the same extremes that got the banks in huge trouble pre-GFC. So I tend to think that the Basel rules and the Volcker regulations and all of that complex of regulatory oversight that was designed to make the banks completely sound also took them out of some very important functionality that they performed. It also wasn't bad as a profit maker for those banks in a world of low interest rates where it's hard for them to make money anyway. So I'd like to see some progress on that.
Okay. All right. So we have 3 minutes left, and there are 3 of you. So I would like to ask you, and look, you know, we're all friends here. We're not going to say anything outside of this room, but we want your best opportunities, your best trade ideas for your favorite audience right here. So if I can just kind of go around, what should we be thinking about? What should we be looking at? What are you most excited about? What are you kind of most staying away from? And we can end with that as a kind of lightning round. So does anybody want to go? And please, it's nobody, don't all say the exact same thing. Who wants to go first?
Well, I'll start. So in case somebody else has the same idea, but I mean, I just summarize what I said before, and that is there's a reckoning ahead of us. There's been fun, you know, just following the Fed, buying what the Fed's going after. That's been a good trade. But the reckoning's ahead. It's a reckoning ahead in the U.S. It's a reckoning ahead globally. There will be both, you know, defaults, but in the new world, it'll also be restructurings, capital that make things happen. And so, you know, that's the world I know, and there's going to be a lot ahead in that space.
At our global conference, we're going to call it the credit panel, the day of reckoning. And so that's
there you go. Yeah, we like that.
I think we're going to see, we've seen a bunch of waves of things already. As I mentioned, structured products had some really interesting capital structures that were over leveraged. I think there are more out there like that. But I think it's going to be waiting to see some of these companies that aren't built to last in the current real environment and working in partnership in a solutions way with the sponsor and with 1 or 2 other people like the character of George out there, where you can actually help the PE firm. You're not in a competitive scrum like buying in the public markets. And the other area I would say is, I think, real estate lending. I think the value added of having a strong real estate underwriting group today is quite high because of the disruption going on in that world. We don't have clean visibility on the office market, for example, yet. But we do know that there are a lot of landlords who are both suffering from political encouragement not to charge for rent, and by the fact that everybody's gotten used to Zoom. And also, on the other hand, by the fact that they need social distancing. How those unfold, we're seeing a lot more flow of opportunities. We'll see what connects. But I think that's a real area to focus on.
Okay, Rishi, last word to you.
Thank you. So we have a private markets business and a liquid alts business. On the liquid side, much of the compelling ideas naturally are sourced around dislocation opportunities, NPLs, credit-based dislocations, generally speaking. So on the private side, we kind of believe that this is the time for us to be providing the shovels to the gold diggers. And what I mean by that is, the secular trend behind e-commerce, the shovels for that is the logistics, warehousing, distribution space. So we are, secular and long-term investors behind that domain. Of course, doubling down on our winners is part of that same story.
Well, in the gold rush, the shovel providers are the only ones that made money. So thank you so much, gentlemen, for such a fantastic discussion. We're very grateful to have your expertise and for you to share with our stakeholders. And I wish you the best in health and prosperity going forward. So thanks again.
Thank you, Staci.
Thank you. Yeah, great.
Take care, guys.